Hey guys, my name is Shivam Gupta and I'm here with my first YouTube video to help you people understand valuation better. So let's get started. Basis of valuation. Valuation is knowing the worth of the asset, knowing what the asset is actually worth. Knowing the worth helps us in taking intelligent decisions. Such decisions include the investment for a portfolio, in deciding appropriate price to pay or receive in a takeover, the dividend choices and financing choices. Also, to increase the shareholders' value, we need to understand the right mix of debt and equity in a capital structure. Approaches to valuation. Generally, there are three types in which we value. First, a discounted cash flow method, which is most theoretically sound one and generally most commonly used. The other is relative valuation. The third one is contingent claim valuation. We'll be discussing each of them one by one. Starting with discounted cash flow method. Discounted cash flow valuation relates the value of an asset to the present value of the expected future cash flows of that asset, discounted back at a rate that reflects the riskiness of these cash flows. There are three major inputs to DCF, the first one being discount rate. Discount rate is dependent upon the type of cash flow we use. The type of cash flow available are free cash flow to the firm, which includes the cash flow after taking account for all operating expenses. In this case, we use the weighted average cost of capital. The other being free cash flow to equity. In this one, we take account for all the interest payments and the debt payments, and the residual which is left over is known as free cash flow to the equity, which is the free cash flow available for all the shareholders, and the discount rate used is the cost of equity. The next being growth rate. Growth rate in the terminal value shall be always taken as less than the risk-free rate and also with caution, as increasing the growth rate also implies increasing the reinvestment ratio, which also decreases the terminal value. Relative valuation. Under relative valuation technique, we value an asset by looking at how the market prices the similar assets. We compare the company to other similar companies by looking at trading multiples like PE or other ratios such as EBITDA. For example, if a company A trades at 20 times PE ratio and company B has an earning of rupees 5 per share, then company B's share must be worth rupees 100 per share. That is 20 into rupees 5. EBITDA is the other such ratio which is used most commonly. Contingent claim valuation. A contingent claim or option is an asset that pays off only under certain contingencies. If the value of the underlying asset exceeds a pre-specified value for a call option or is less than a pre-specified value for a put option. Option can be valued as a function of the following variables: the current value and the variance in the value of the underlying asset, the strike price which we generally keep as the debt of the company, and the time to expiration of the option, and the riskless interest rate. This method is generally used for the companies whose equity value is negative when calculated through the DCF approach. Role of valuation. Valuation is required for the portfolio managers, acquisition analysis where we take over other companies, in corporate finance to understand best mix of debt and equity in the capital structure to increase the shareholders' value. Valuation is also needed for legal and tax purposes. Here comes the end of the video. Thank you so much for watching. Please don't forget to like, share and subscribe the channel.